Yo, what's up, everybody? It's Tuesday, June 10th. Update on the chainsaw. No luck getting it started. It starts and then it stops. The carburetor's brand new. Fuel lines are brand new. The fuel filter's brand new. So the spark plug is brand new. The spark arrestor's been cleaned. What else? The air filter's brand new, so I don't know what's going on. Anyway, let's talk a little bit about the market, the Mercado. Quiet day. Supposedly everybody's waiting around for any progress or word on the U.S.-China negotiations on trade, but you know, that's going to be a headline print. Here's the thing that interests me, that I find very fascinating. And I mentioned this, I think, in a previous video. It's the fact that throughout this whole entire rally, since the bottom in April, I think it was like the week of April 7th or something like that, this whole entire rally, all right? I think the S&P has risen like 1,200 points. All right. Yeah, it was like 4,800 in April. It's like 6,000 right now. That whole entire rally had zero participation by institutional asset managers. And when I say that, I'm talking about, I'm looking at futures commitments in the S&P E-mini. Back in April, at that bottom, they were net long. That's longs minus shorts. They were net long about 810,000 contracts. And they're basically net long the same amount right now. So no increase in their net long position. 1,200 point rally in the S&P. Pretty fascinating. I mean, they basically have been sitting there watching this whole thing go up. So who's been buying? At least from what I see in the commitments data, it's been dealers that have been covering shorts. They covered about over 120,000 shorts in the S&P. Dealers those are like Wall Street banks, okay? JP Morgan, Citi, Bank America, Wells Fargo, Goldman, Morgan Stanley, those are those guys, all right? They've been covering short. So this whole thing has been short covering by the banks. Now, when I look at that and I see juxtaposed against that, okay, the fact that fiscal flows are super strong. See, I don't think this thing is coming down. I mean, something would have to happen in terms of slowing down or reducing those fiscal flows. So when you have this situation where you have these really, really strong flows, all right, that's like energy going into the market. And then you have this group, a very important group, institutional asset managers, just sitting there watching this same thing go up, doing nothing. I mean, I'll ask you, what do you think is going to happen? At some point, they're going to have to jump in. I mean, they have to. I think it's kind of like almost like their fiduciary responsibility. They have to own stocks, or they have to own stock proxies like futures contracts. They're going to jump in, and this thing is going to be like a melt up when they do. Now, again, I say that that's going to happen as long as something doesn't evolve or something doesn't come about that changes the fiscal flow situation. I don't know necessarily what that would be. Maybe it would be, if I'm looking at this, the big beautiful bill, and I don't even know if this is part of the bill, but there's a whole bunch of rescissions. Rescissions in fiscal parlance, those are cancellations of contracts. Okay, that was all the Doge stuff. That was all Doge. So we're going to get a whole bunch of cancellations of contracts, and that could impact. That could impact. But something, in my opinion, something would have to negatively impact the flows for that scenario that I just described to you, where you have all these institutions sitting on the side watching the whole thing go up. Something would have to happen to the flows to make their, sitting on the sidelines work out for them. Otherwise, they're going to jump in. I'll tell you one scenario which would be kind of funny and ironic at the same time. Suppose they jump in, right? Watching this thing go up, maybe S&P not far from all-time highs, and then they start jumping in. And then after they jump in, let's say they go back up to 1 million net long. And I talked about this months ago when they were like 1.1 million net long. I said, be careful, because, when they get that loaded up, that's the potential for a significant correction. And then we had the significant correction. But what if they get back up there again, and then all of that cutting, all of those cancellations, all that fiscal reduction starts to hit? So think about that. That would be classic, right? Because they did nothing at the bottom. They didn't buy. And then they jump in after watching it for, 2-3 months. Then they jump in at the highs, at new highs. And then all of a sudden, bam, the fiscal stuff starts to hit. Don't forget, these layoffs that Doge put through when Elon was there, they take place at the end of the fiscal year. They take place after September 30th. So that stuff still has yet to kick in. So I think that's a very plausible scenario, where you get this melt up now based on institutional asset managers coming in, throwing in the towel, the FOMO, fear of missing out. They jumping in, they buy, they run their position up again to over 1 million contracts net long. And then boom, all that fiscal drag starts to hit from the tariffs, from the rescissions, the contract cancellations, from the layoffs, right? What do you think about that? I think that's a very plausible scenario. So we'll see. But right now, I just keep saying, with these flows the way they are, to use the swimming pool analogy, that pipe, that water pipe flowing into the pool, that's coming out at a massive volume and a very rapid pace. All right? So, that's my analytical framework, as you know. I don't go against that. When I see that, like I said, that's energy. That's like kinetic energy. I don't go against that, because that's just, that lifts everything up, risk assets. I think tomorrow we get a CPI. Look, I'll mention this in the bonds, and I said it in a prior video. The Fed has put a lot of pressure on the bond market, in spite of the fact that we've seen a string of data, a pretty, long string of data, actually, that would have justified, if nothing else, it would have justified just a change in the tone, in the rhetoric, in the messaging that the Fed is putting out. But they, and I did many videos on this, about the dishonesty of Jerome Powell. Oh, by the way, let me mention something which I think is very interesting. Today, it was reported that Trump is considering putting Bessent, Treasury Secretary Bessent, in as Fed chairman. Now this, I think this would be, this is like a typical Trump. He's playing 4D chess. This is like, the end run around Jerome Powell. Just mentioning Bessent's name, because Bessent, he's Trump's man. He's been out there too, talking about lower interest rates and stuff like that. So I mean, if that actually happens, and I don't even think we would have to wait until next year when Powell's term is officially up. I mean, the markets would start to focus on, if Bessent was named as the next Fed chairman, even right now, before the end of Powell's term, if he was just named by Trump, you would start to see the markets react to Bessent's comments, messaging, and outlook on interest rates. And I think it would be dovish, because that's where he stands. So keep an eye on that, because I think this is a very, very interesting and clever development by Trump. And basically, this was mentioned by Bessent a couple of months ago when asked about, Powell and the situation and rates and why aren't rates coming down. Actually, Scott Bessent said, when a new guy is named, even before it's time for that person to take the, over the Fed, markets would start to follow what that person's outlook is. So that was very, very clever. I think that was very clever. So pay attention to this. Anyway, I was talking about the bonds. Powell's been very dishonest with his constantly saying, oh, we're going to be data driven, data dependent. And yet all the data, it was benign, really. I think had a strong case there, like I said, at least for switching the tone of the messaging. And if anything, he's gotten more bearish. So in the short term, until these other things develop, in the short term, I don't think that's good for bonds. I think every time there's going to be a rally, you're either going to get a Fed member coming out to squash that, or investors, traders are just going to look for, instead of looking for the so-called silver lining. Look, we've had a lot of good inflation reports, and it hasn't helped to bring rates down because of the messaging from Powell and the rest of the Fed members. I mean, they're right now, in my opinion, and I said this before, it's just speculation on my part, but I think Powell, number one, it's kind of like he has it out for Trump because Trump's, public criticism of him. And number two, Powell knows he's gone next year. And I think he's positioning himself for a really high-paying job at some hedge fund. And I think he's running cover for some of these hedge funds. And we know these people. The Paul Tudor Jones, the Drunkenheimer, the Goonlocks, they're short the bond market. And I think new guys have come into the picture because all we hear about every single day is this nonsense. Number one, the nonsense about the debt. And number two, there's been a lot of new adherence to this short bond trade from the downgrade of the U.S. credit rating by Moody's. Okay, so they're all jumping on this boat, and I think Powell's basically accommodating them. So until a new guy is named, these rallies are not going to last, unfortunately. Anyway, that's it for today. Please like and subscribe, and don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. See you tomorrow. Bye.